But let's talk about what I consider to be market law number one. This is one of, in my opinion, the most profound discoveries I've ever made years ago. It's called the 3 to 5 bar rule. The law goes as follows. During normal market environments, the operative word here, ladies and gentlemen, is normal. Okay? During normal market environments, stocks and other tradable items cannot move in the same direction more than 3 to 5 consecutive bars in a row. I'm going to repeat that. That's a very important point. During normal market environments, stocks and other tradable items, options, bonds, futures, it doesn't matter, right, cannot move in the same direction more than 3 to 5 consecutive bars in a row. What this means is that after a 3, 4, or 5 bar run-up, the market tends to sharply reverse, creating a nice trading opportunity. Neither the bulls nor the bears can win more than 5 bars in a row without passing the baton to the other side. So in essence, after 3 to 5 green bars, you need to start looking for what color? Red bars. After 3 to 5 red bars in a row, your assumption must be the market's primed for not only a green bar, but a series of green bars. That's the 3 to 5 bar rule. Lastly, this law can be said this way, as I just mentioned. After 3 to 5 green bars in a row, the trader should look to take advantage of an upcoming series of red bars. After a 3 to 5 red bar move in a row, you should be looking for a series of green bars. Now, of course, life would be grand if it were truly that simple, but that law is far more prevalent than it is not. This 3 to 5 bar cycle rules the market 85% of the time. And you can use this law to turn it into money. Here is that law demonstrated on this slide. We're looking for, whenever we have a stock that is predominantly in an uptrend and then experiences a 1, 2, 3 bar move to the downside, your assumption must be to think buy. That stock may not rebound after 3, and it may produce a 4th bar down. And your assumption must be to really think buy. And of course, it may not rebound after 4, and it may actually move to 5, and then I want you to really, really think buy. So it's 3, 4, or 5 bars back that tends to produce a ricochet back to the upside or a rebound. And what I train my traders to do is after a stair step down, a 3 bar stair step down, I want them sitting right above the high of the previous bar waiting to buy. So if the high of the previous bar is $40, I want them sitting at 40.01 waiting to buy. I want them to get ricocheted right into the rebound. If the stock does not trade above the previous bar's high and we get another down bar, I want them lowering their buy to 1 penny above that bar's high. And let's say that bar's high is 39. I want them sitting right at 39.01 waiting to be ricocheted right back into the rebound. And if it doesn't happen on that bar and we get another bar down, they will just continue to drop their buy until they get ricocheted into the rally. Does that make sense? once they get rebounded into the rally, we're not guessing that this is the bottom. We need to be sure it's the bottom by ensuring that the stock is coming back. Does that make sense? Once we're in the stock, I want my traders placing a protective stop 1 penny below the bar that they bought. That's our protective stop method. On the downside, let's say a stock is experiencing weakness to the downside in the form of a downtrend. We teach our traders that we want them waiting for a 3, a 4, or 5 bar rally back toward a declining moving average, and we'll talk about that in just a moment. I want 1, 2, 3 bar rally. Once we get a 3 bar rally against a downtrend, a 3 bar micro move against a downtrend, I want my traders sitting 1 penny below the previous bar's low, waiting for a drop in the stock. If the stock does not drop below this prior low on the following bar, then we raise our waiting point. And I want them waiting after 1, 2, 3, 4. They would then wait 1 penny below that bar's low. And they'd be waiting to get knocked into the stock on the short side. If it doesn't happen after 4, the odds are extraordinarily great it will happen after 5. They're going to raise their waiting point now to 1 penny under that bar's low. And ultimately, they will just stair-step higher until the decline ricochets them in on the downside. Does that make sense? Once they enter a bar short, their protective stop is 1 penny above the entry bar's high.